Hope all is well, brothers. My name is Tito Clark. I went over with DC Graduate Chapter in 1995. I became a lifetime member of GrooveFi Groove in 2004, and I'm currently a part of the Missouri Graduate Chapter of GrooveFi Groove. In this presentation, I just wanted to talk about the future state of the financials for GrooveFi Groove and a little bit about the present state. Let me just start off by saying the balance sheet of Groove looks very good. Okay, when you look at assets equals liability plus owner's equity, you clearly see that Groove's assets are greater than liabilities. You clearly see that Groove has good cash flow, and Groove has a ton of owner's equity. In other words, Groove has a ton of equity capital. That being said, we're going to deep dive into that equity capital and what can be done, talk about the future of Groove's financials, and I hope you enjoy the presentation. On this slide, I'd like to discuss the financial growth model, and it's a very simple one. It's essentially, from the previous slide, G times the exponential of your growth rate multiplied by time. And from this slide, you clearly can see that when you use a simple financial growth model, you can achieve, Groove can achieve 4,000% return, as demonstrated by this chart with TQQQ. Now, between 2013 and 2016, I was telling brothers about this TQQQ and to invest in it because I also have a master's in information management and over 25 years of experience with SAP enterprise software and all sorts of interfaces with SAP. And I knew that this was going to be a good buy. So now we're here again, and we have a market crash. And now is another good opportunity where I believe that another 14,000% can be made with a similar time span of from 2011 to 2022. So let's just assume 2022 to 2032. But just look at this chart. I think that at the 2008 conclave and at the 2009 conclave, someone should have proclaimed this in some form or fashion and presented it to the brothers so individual brothers could make money and individual grooves could make money. That being said, if you had invested Groove had invested $5,000, before the year 2022, before the market crash, it would have been $7 million. This slide is an additional illustration of that simple financial growth model, which again is going to be G e to the GT. That's how I explain it to the Swanksman here in Missouri City Graduate Chapter of GrooveFi Groove. So again, this slide is looking at QLD versus TQQQ. Both of these securities are ETFs, and essentially it's a bundle of the top tech companies, right? Apple, Microsoft, Google, the common FANG, and then some. TQQQ is a 3x of the NASDAQ. So if the NASDAQ does 10%, TQQQ will do 30%. QLD is a 2x, meaning if the NASDAQ does 10%, QLD will do 20%. But as you can see here from the 5-year chart, when you look at that simple growth rate again, that G, E to the GT, you can clearly see, right, that TQQQ did the 14,000% and that QLD did somewhere around 4,000%. But the reverse is there too. As everything crashed, you see that TQQQ crashed even more, and QLD, it crashed as well, but not as much. Either way, I just wanted to show you that that's just a way of dealing with risk in a simple manner. Are you going to do 3x or 2x? The explosion to the upside is good for you. Hey, but if it goes against you, it's a similar type of equivalent magnitude of a hit. This slide here is another illustration of the financial groove growth model. And again, it's looking at TQQQ. but instead we're looking at it versus UGL, which is a gold ETF. So UGL represents gold, and as you can see, over a 5-year period, TQQQ did the 800%, right? And UGL did 54%. Gold did 54%, which is not as good as 800, but still very good. And as you can see with the crash, gold has stayed stable, and the NASDAQ, in this case the TQQQ, which is the 3X, has dramatically fallen, where now it's only a 200% gain versus an 800% gain. But in retrospect, a gain is a gain. So if Groove had missed selling in December 30th or December of last year and missed out on making 800%, that would be okay. That would be okay in the long run. The previous slides were really to illustrate and express how Groove can use a financial growth model, a Groove financial growth model, to get future expected returns and gains. And the previous slides are also there to express how Groove has also missed some opportunity. That being said, here are some execution recommendations, right? I know we have a new Chief Financial Officer, and that's very good, right? But what our CFO can do for Groove is apply capital asset pricing model with general corporate finance principles to understand and provide a roadmap for future expected returns. Now, that's a lot for the CFO to do, so our CFO is going to need a team. And on that team, he should have someone who has a master's in finance, an MBA, someone who has a master's in business analytics, or someone with statistics, hardcore masters in statistics. Also someone with a master's in history, and we also need a mathematician. We want somebody with a graduate degree in math. You put that team together, and you'll see that Groove can actually get those type of returns that I showed you in the previous slide of the 800% and the 14,000%. Now, we have data that's on our side, and we have education as an organization that's on our side. And we need to take advantage of all the data and experience from the previous crashes to better anticipate and play the future crashes and the current crash of 2022. So if you go back to 2020, 2018, 2008, 2001, 1995, all the way back to even 1962, you will find that we had these interest rate issues, we had oil issues, we had inflation issues, and you can see how the government, how they did their economics, good or bad, but we can actually use that data and play things forward such that Groove can increase its balance sheet and have basically just a simple financial growth model that we can use. On the next set of slides, I'm going to show you a small example of what this CFO SWAT team will be doing and how they can make recommendations for a future financial roadmap for Groove. The content that I'm about to show you was put together by my Johns Hopkins Carey Business School classmate Daniele Viana and myself. Daniele put together more of the qualitative analysis, and I put together more of the quantitative analysis, as you'll see in the next couple of slides. This slide is an example of the qualitative analysis that Daniele did with regards to the strategic rationale behind why Barrick Gold is a good buy. At a high level, Barrick Gold is the #2 largest gold mining company in the world. It mines both gold and copper, and moreover, it's a multinational corporation, has positive free cash flow, and they have currently made their pricing models, their budget, their costs are centered around gold being at $1,200 an ounce. Now I want to take a look at Barrick Gold's financial performance at a high level. The main takeaway from this slide is that Barrick Gold has a positive free cash flow. It's very robust. It's at the highest levels it's ever been, or one of the highest levels it's ever been in its history. Moreover, the gold and silver mining sector in general has positive free cash flow this year, and obviously they had it in 2020. 2021, even though there was some volatility and consolidation in the price of silver and gold, the miners still had record-breaking positive free cash flow. On this slide, we're going to discuss weighted average cost of capital for Barrick Gold at a high level. Essentially, there is a cost of equity and a cost of debt, and whenever you do a transaction such as a merger, acquisition, or divestiture, these deals are done using a combination of equity, which could be stock, and debt, which is taking out a loan. So what we have here is we went on Moody's and we took a snapshot of Barrick Gold's credit rating, and I believe here it was Baa1 rating as of October 29, 2020, which makes sense because, you know, the gold and mining sector, they are on a comeback. So Baa1 rating makes sense as of 2020. I'll have to go take a look at what their ratings are now, but it makes no difference. Let's just use a Baa1 rating, even if it is got upgraded to a AA, right, in terms of its credit rating with Moody's. That being said, when you put it all together, the weighted average cost of capital for Barrick Gold is close to 7%, 6.8%. Now we're going to look at the true equity value per share for Barrick Gold. And from the previous slide, we're using the 6.8% as the weighted average cost of capital to do our financial model with regards to determining the terminal value for Barrick Gold and an estimation of the future free cash flow over the next few years. All that being said, the equity value per share that I calculated was $58, or it's rounded, $59. Now, today's price, which I'll show you, and I believe 2021's price as well, Barrick Gold's price is close to $20. So it's greatly undervalued. And in the top right-hand corner here, could be your left-hand corner, there is a what-if analysis matrix where I did some analysis between different combinations of the free cash flow growth rate versus the weighted average cost of capital. And the weighted average cost of capital takes into account the rising interest rates. Okay, so let's just say, pretend that doesn't say WACC there, pretend that just says Federal Reserve, Jerome Powell interest rates, and he's raising them from 6 to 11, and what kind of impact does that mean? Well, this equity value analysis takes that into account. And taking that into account, you could see that the lowest price we have here in terms of the true value for Barrick Gold is $29.35. And if volatility and positive variances go our way with Barrick Gold could go as high as $229 as a 52-week high sometime in the future. These are older stock prices for Barrick Gold from 2021. But if you were to look today, Barrick Gold stock price is relatively the same. In 2020, the peak was at 30. It'll absolutely retest 30 in the future. And as I've shown you from the previous analysis, that 30 isn't even its true value. It's really closer to $59. And depending on how interest rates will go and how volatility could go with regards to the price of gold, a Barrick stock price could go even higher. On this slide, we're just demonstrating and showing the various supply and demand attributes surrounding gold itself. And as you can see, the supply and demand of gold varies per industry and per sector, for example, between technology and jewelry. Another type of analysis that the Groove CFO SWAT team could be doing is using the Black-Scholes-Merton model to come up with favorable call options or puts that would be favorable to Groove. In this case, I previously did an analysis on UGL October call options, strike price of $70, and UGL is gold. It's a 2x on gold. And when you look at this, this is a what-if analysis based upon different combinations of risk-free interest rates. And risk-free, we're referring to the 10-year, which is also impacted by what the Federal Reserve is going to do with regards to raising interest rates. And we take that into account in combination with volatility, different types of volatility that could occur. And in this what-if analysis, I previously looked at between 10% to, I think I went out to like 200%, just something crazy. And as you can see, on March 8th, 2022, Ukraine invaded and gold shot up along with silver. And you can see that it shot up. That call prices shot up from $2 or $3 all the way up to $13 range. And just by using this what if analysis and a little bit of probability and some historical information from that, the masters in history that we'll have on the team, Groove will be able to make some of these calls and benefit. On this slide, we have the graphical depiction of the what-if analysis from the previous slide. So you'll see that line that's shooting up there, and you'll see that peak. Well, that peak point for the UGL 70 call price is in that $13 range as calculated by the Black-Scholes-Merton model previously. So I mean, this is a very powerful model that we should use as an organization to better align with making powerful investments with low risk and not really taking into account too much money. As I showed you before with TQQQ, $5,000 turned into $7 million. But say it went the other way and Groove lost that $5,000, well, that's the risk that we take. However, our CFO, along with his SWAT team, will make sure that the portfolio is diversified and properly weighted based upon different correlations, that Groove really is going to come up ahead. Thank you for your time. I hope the presentation was enlightening. On the next slide, I'll have my contact information and some rates. Well, brothers, I understand. I know that I threw a lot at you there with the presentation. I just felt that something like this was needed back in 2008, 2001, and if you go back to the previous slide, you'll have other dates there where we had conclaves. And I think if we talked about some of these concepts, then Groove would probably have that 7 million or 20 million or 100 million or more, and we can really get our groove on. So here are my rates. Again, I'm Ernesto S. Clark II. I have a master's in information management from Arizona State University, and I have a master's in finance from Johns Hopkins University Carey Business School. My email is eclark@tgrgroupinc.com. My consultation rates are $150 to do finance tutoring. That could be either for graduates or undergraduates. Just students, period, it's $150. For individual consultation, it's $500, $1,000 for small business consultation, and then $5,000 for Fortune 500 and 1,000 companies. Now, these are at my hourly rates, but I am flexible. I'm just not a hard line where I have a consultation and after 62 minutes I say thank you for your $500 and goodbye. It's nothing like that. But in some cases I've spent 3 hours with some of my individual consultation clients, and they just paid me $500, and I did not request or invoiced 1,500, even though some of them were expecting that. So really it just depends on our relationship between myself and the clients, and also depends on the type of questions that my clients have, because in some cases the type of questions my clients have benefit me as well, because if we can answer them, then there's profit down the road. Again, these are my rates. I know it could be daunting to put together our Groove CFO SWAT team of the combination of elements of the graduate degrees of brothers that I've indicated. It could take months, it could take a year, but if Groove wants to accelerate some of the concepts that I've talked about in terms of a Groove financial growth model and truly implementing it, these are my rates, and I think Groove could benefit from a one-time fixed consultation and really grow the assets of Groove. This slide just contains some of my references with regards to some of the photos that I used in the presentation. Thanks again.